Good morning, and welcome to the Bulls, Bears, and the Bell Morning Edition. Thank you for joining us.
Good morning. It's certainly shaping up to be a pivotal day.
Absolutely. We know your time is valuable, especially, when markets are this turbulent. So our mission, custom built for you today, is to dive straight into the sources, really cut through the sheer noise.
There's a lot of noise out there right now.
Exactly. And deliver the essential intelligence you need to navigate this incredibly volatile October close and the dramatic risks shaping today, October 31st.
Yeah, yesterday was a bit of a gut punch, wasn't it? October officially closed with a decisive downturn, and today we are staring down the barrel of immense immediate volatility.
Right. Our deep dive, it's really designed to be your essential shortcut. We're decoding the key drivers, assessing the market's mood, and mapping out those colossal risks.
The risks that are shaping not just this final trading day of the week, but also, crucially, the strategic positioning for next week's big economic events.
Exactly. It's all connected. Okay, so let's unpack this central conflict we're seeing play out right now. It feels like a powerful battle for control of the indices, wouldn't you say?
Definitely. On one side, you've got this persistent, overarching bearish pressure. It's stemming directly from the Federal Reserve's monetary policy. That's the big macro headwind pushing almost everything down.
Almost everything. Because on the other side, we are seeing these specific high-conviction fundamental wins. They're popping up in selective sectors, companies delivering real operational excellence that the market just has to reward, even in this environment.
That's the tension. And you, the listener, need to know exactly which of these forces is winning the battle today. Will the expected cyclical strength, maybe from energy earnings, be robust enough to drag us out of that tech-driven slump we saw yesterday?
Or will the Fed's aggressive talk just continue to smother growth expectations?
Right. Understanding that dynamic is critical for managing the intense volatility we are expecting this morning, and maybe more importantly, for strategically placing capital ahead of next week's major data releases.
All right, let's start with the main character, or maybe the antagonist, in the room right now. The Federal Reserve. Markets had built up a pretty healthy head of steam leading into midweek.
Yeah, things were looking up for a bit there.
But the whole environment just completely soured on Thursday, October 30th. And it wasn't just a slight downturn, it felt like a rejection of that recent rally. The immediate risk driver, without question, is the Fed.
Well, what's truly fascinating here is how the Fed managed to be both accommodative and hawkish almost at the same time.
How so?
Well, they delivered the expected minor rate cut, right? The one the market had already completely priced in, no surprise there. But then Chair Jerome Powell immediately followed up with this stern, unequivocal warning that just changed the entire tone.
That's the pivot everyone's talking about. He explicitly cautioned investors against that Pavlovian response. The assumption that just because they cut once, further easing or a quick reversal was somehow guaranteed.
Exactly. It was like a verbal counterpunch to the market's recent enthusiasm. He insisted, yet again, that policy would remain strictly data-dependent and restrictive for the foreseeable future.
It felt like he was saying, don't get ahead of yourselves.
Pretty much. That rhetoric wasn't just throwing cold water on the rally. It was, I think, an acknowledgement that the market's expectations had maybe drifted too far into optimism.
Okay, so what was the immediate consequence? We saw it play out, right?
We did. First in bond markets, then hitting equities. Investors were suddenly forced to reprice the probability of rates staying elevated for longer. That's the aggressive higher for longer dynamic really taking hold again.
And we can actually put a number on that, can't we? Using the CBOE FedWatch tool. What happened there?
Yeah, we saw an immediate, pretty sharp reaction. That FedWatch tool, which tracks the odds of future rate moves based on options trading, it scaled back the probability of a December rate cut down to roughly 69%.
69%. Now, that still sounds like it's more likely than not.
It does, but the key takeaway is the speed and the magnitude of that shift. Just before Powell's speech, that probability was significantly higher. It was pushing, closer to 80%.
But help us understand why that change, dropping from, say, closer to 80% down to 69%. Why is that so impactful? Why does it create so much volatility? It's only about, 9 or 10 percentage points.
Well, it signals a fundamental collapse in conviction. The market has sort of built this consensus around a smooth path towards accommodation, towards easing. When that consensus breaks, the fixed income world especially has to unwind positions that were betting on that guaranteed easing.
Oh, okay.
Think about it. A 31% chance of no rate cut in December. That's actually a very high probability when you consider institutional trading floors operate on like razor-thin margins and high leverage. So
Right.
that shift, it instantly increases the cost of money and injects genuine uncertainty back into everyone's forward modeling.
Okay, so that uncertainty brings us straight to the core issue plaguing the Nasdaq and those high-growth stocks. Why does this worry about interest rates hit the stock market so hard, especially technology, which often seems like it operates independently of daily bond yield fluctuations?
This is probably the most important concept for our deep dive today. It's what we call the cost of capital connection, and it's rooted in discounted cash flow modeling, or DCF.
Okay, DCF, break that down for us.
Think about how any company's valuation is determined, right? For a mature, maybe a value-oriented company, let's say an energy giant, a big chunk of its value comes from cash flows it's generating today or in the very near future.
Okay, cash now.
Cash now. But for a tech company or maybe a biopharma growth stock, that cash flow, that profit is much further out.
It's based on future potential.
Precisely. The value of a high-growth company is mostly based on the discounted present value of its future cash flows, often projected years, sometimes decades down the line. So when the Federal Reserve raises interest rates or even just signals they'll stay high, it significantly raises the discount rate. That's the required rate of return investors use to figure out what those future earnings are worth today.
Which means money earned 10 years from now is mathematically worth less today if rates are higher.
Exactly right. When the discount rate is low, those distant cash flows are still worth quite a lot in today's dollars. But when the discount rate rises, like Powell just signaled it might stay high for longer, that process of discounting those far-off earnings back to the present, it absolutely hammers those long-duration growth assets.
It hits them the hardest.
The hardest. It's basically a mathematical process of valuation destruction for the highest multiple stocks, the ones that tend to dominate the Nasdaq. Value companies, though, with their immediate tangible cash flows, they're relatively more insulated from that specific mathematical shock.
That concept perfectly explains the divergence we saw in yesterday's trading then.
It really does.
Okay, so that detailed explanation of discounted cash flow, it really sets up the concrete evidence we saw yesterday. We absolutely witnessed a stark divergence in performance on October 30th, and that's the textbook sign, right? Institutional rotation money fleeing high-risk growth is already well underway.
Oh yeah, the numbers are pretty unambiguous. Those high-duration growth assets, the ones most sensitive to rate shocks, they were the clear losers. The NASDAQ 100, IUXX, closed down a sharp Monica 1.47%.
Ouch.
And the broader S&P 500, SPX, it fell almost a full percent, down minus 0.99%. That's a massive rejection of risk right there.
But then look at the relative strength. The Dow Jones Industrials Index, DOY. It's weighted much more heavily towards value and cyclicals, and it contained its losses remarkably well. It only slipped minus 0.23%.
That small loss is really telling. It signals money was actively moving into perceived safety, or at least relative safety, and away from those rate-sensitive sectors.
Well, we can trace this divergence directly back to those rate expectations we were just talking about.
Absolutely. When we dig into the sectoral impact, the areas most dependent on low borrowing costs took the biggest hits. The Technology Select Sector SPDR ETF, INFT, it declined by a stiff manic 1.28%.
Okay.
But the Communication Services Select Sector SPDR Fund, TALS, which holds names like Meta and Alphabet, saw an even larger drop, manic 1.69%. These sectors are just being mathematically repriced because their future growth models suddenly look more expensive to finance.
And their future cash flows are worth less today. Got it.
Exactly.
Now, here's where it gets really interesting, though. Within technology itself, the whole AI trade seems to be undergoing massive internal scrutiny, especially after some recent earnings reports. It feels like it's no longer enough just to have a catchy AI initiative or, a slide deck talking about the future.
That is the critical aha moment for investors right now, I think. The market has moved decisively past just generalized enthusiasm for anything AI. Investors are now distinguishing between companies based on actual execution, can they actually monetize it, and critically, capital efficiency. We saw this powerful dichotomy emerge from the reports, really defining what the market sees as a good AI company versus maybe a risky one.
Okay, let's break that down. Let's look at the winners and losers based on those criteria. Alphabet, GOGL, seemed to be the clear featured winner here.
Yeah, Alphabet was definitely rewarded for execution. They highlighted accelerated growth in their Google Cloud segment, and they explicitly attributed it to AI achievements and, importantly, immediate customer uptake.
So they showed the money.
They showed the money.
Yeah.
The market rewarded that tangible evidence of monetization and revenue generation happening today. It confirmed their investment in AI was actually generating real high-margin results, which helps justify their valuation.
Okay, so conversely, Meta platforms, Meta, became a featured loser. And that's despite their huge commitment to building the AI infrastructure of tomorrow. Why the punishment there?
Meta became the cautionary tale, and it was because they projected much faster capital expenditure CapEx spending for 2026 compared to 2025.
Okay, spending more money faster. Why is that bad?
Well, the fear centers on whether that massive infrastructure build-out represents necessary investment or, critically, in this new rate environment, does it represent reckless capital requirements that just balloon the valuation risk?
Cost of capital again.
Exactly. When the cost of capital is high, the market loses patience, frankly, with these multi-year non-revenue generating investment cycles. Meta is essentially asking investors to fund a huge multi-year bet at a time when money is expensive, and the marks reacted by punishing them for it.
So investors are drawing a really clear line now. It's execution that monetizes now versus expensive commitment that maybe pays off later.
That seems to be the dividing line, yes.
So if high-growth tech is being selectively punished, where is the money actually finding a safe harbor? Where did it go yesterday?
We saw a clear rotation into defensive sectors, ones that possess strong fundamentals and what you'd call inelastic demand, things people buy regardless of the economy.
Like healthcare.
Exactly. The Healthcare Select Sector SPDR ETF, HLTH, actually posted a positive daily return yesterday, plus 0.17%. A small gain, but positive nonetheless.
And what drove that?
That strength was largely boosted by Eli Lilly, LLY. It surged plus 3.81% on strong clinical and commercial news for its pipeline. This confirms that capital is actively rotating toward non-cyclical, strong fundamental growth stories, companies whose demand profile is more insulated from the immediate economic effects of the Fed's actions.
Okay, let's shift our focus squarely to today, October 31st. Given yesterday's pretty dramatic sell-off, this final trading session of the week is absolutely packed with high-impact catalysts.
Yeah, it really is.
And the market seems like it desperately needs some kind of cyclical counterattack to offset that technology drag we saw. That buffer often comes from the traditional value-oriented names reporting before market open, right?
That counterattack is definitely scheduled to begin this morning. We've got crucial earnings reports from the energy giants, Chevron, CVX, and ExxonMobil, XOM. These companies are massive, absolutely huge, and their performance can really swing the Dow and provide significant support to broader market sentiment if they deliver.
Okay, let's look at the analyst expectations because they seem pretty grim compared to last year's record highs. CVX consensus EPS is $7.29. That's down sharply from $9.72 a year ago. And XOM consensus is $6.87, down from $7.84.
Right. The market has already factored in some significant headwinds for them. Lower commodity prices compared to the peak last year, for one, along with elevated operating costs. So the importance of these reports today isn't really about hitting last year's impossible numbers.
And about the surprise factor.
Exactly. It's about beating these lowered expectations. A surprise beat, even a modest one, could catalyze a significant rally in energy stocks, ENRS, and those are textbook countercyclical plays. If the energy sector catches a strong bid this morning,
It could help lift the whole market.
it provides that necessary support to offset some of the recent technology drag and potentially lift the broader indices today. It's a big if, but it's the potential buffer the market needs.
Okay, so beyond the headline EPS number, what specific details should investors be zeroing in on when those energy results actually drop?
I think the focus really has to be qualitative this time, specifically on their capital allocation plans. What are they doing with their cash?
Meaning buybacks versus spending.
Exactly. Investors want to see evidence that these companies are returning capital rather than, say, hoarding it for risky long-term projects. Are they announcing new, aggressive share buybacks? That signals confidence in their current operations and returns cash directly to shareholders.
Which the market likes right now.
Which the market definitely likes right now. Or conversely, are they guiding for unexpectedly aggressive capital expenditure, CapEx? In this kind of risk-averse environment, return of capital often trumps future expansion plans in the eyes of investors. That's the critical qualitative insight the market is looking for this morning.
Got it. Then we have the other elephant in the room reporting before market open. Berkshire Hathaway Inc., BRKAB. A trillion-dollar conglomerate, its results always shift the institutional focus.
Yeah, and when it comes to Berkshire, we really have to stress this loudly. You have to ignore the GAAP EPS number.
Okay, why? The consensus is $30,862.93, which is a massive drop from $61,900 prior year. That looks bad on the surface.
It looks terrible, but that difference is largely meaningless for understanding the business. It's driven almost entirely by non-cash, non-operational fluctuations in the value of their enormous investment portfolio, things like unrealized gains or losses in their Apple stake or Bank of America or whatever. It doesn't reflect the health of their operating businesses.
So if we ignore the headline gap number, what are the two crucial metrics that investors and analysts will be focusing on for Berkshire?
Okay, first, you look intensely at core operating earnings. This is the actual income generated from their underlying businesses. Think Geico Insurance, Burlington Northern Santa Fe Railroad, their energy utility holdings, See's Candies, all of that.
The real businesses.
The real businesses. This number tells us the true operational health and stability of the conglomerate. If operating earnings are strong, it suggests the core economy, which Berkshire is a kind of a proxy for, is holding up okay.
And the second metric.
Second, and perhaps most tellingly for the broader market right now, we look at the size of their growing cash position. How much cash are they sitting on?
Why is the cash pile so important, especially now?
Because Warren Buffett has repeatedly stated he only makes those elephants, those massive acquisitions, when valuations look attractive. So a record, or even just a rapidly increasing cash pile, which some analysts are projecting could hit a new high.
What does that signal?
It sends a powerful conservative signal to the entire market. It suggests that arguably the most respected value investor in the world views current equity market valuations as generally unattractive, maybe even overpriced. That kind of conservatism from Buffett acts as a sort of psychological ceiling on overall investor confidence.
Interesting. Okay, moving to the macro calendar for today. The afternoon is also packed with data that will frame that Fed discussion for the rest of the day and into next week.
Absolutely. Global attention will be on the release of the Eurozone preliminary HICP. That's their main measure of inflation. The forecast is for a slight deceleration in headline inflation to 2.1%.
Now, what's the implication of European inflation data for us here on U.S. trading floors?
Yeah.
Why do we care?
Well, a softer-than-expected reading say if it comes in significantly below that 2.1%, it would accelerate expectations for European Central Bank, the ECB, to start easing policy.
Okay.
A weaker European economy often translates to a weaker euro. We're currently seeing the Euro-Z pair trading around 1.1562. If Europe slows faster than the U.S., that can actually alleviate some global inflation pressure, which is good. But the main thing is to see if inflation is becoming structurally sticky internationally.
And if Europe is forced to ease faster than the U.S.?
Then it strengthens the U.S. dollar, which creates its own set of headwinds for U.S. multinational companies that sell goods overseas. So it's a complex relationship.
Okay, back home then. We have the crucial U.S. Chicago PMI, scheduled for 14.45 U.S. time, 2.45 p.m. Eastern.
Right. The forecast is 42.3. Now, while this is technically an improvement from the prior month's 40.6, the key thing is that number is still well below the 50 threshold. Anything below 50 signals contraction in regional manufacturing activity.
So still contracting, just maybe less bad than before.
Exactly. Now, if we get a significantly worse print than that 42.3 forecast, it definitely raises legitimate recessionary alarms. But here's the paradox.
Uh-oh.
If the data is very bad, like shockingly bad, suggesting rapid economic weakening, it might actually increase the long-term likelihood of the Fed being forced to accommodate, to cut rates next year.
So bad news becomes good news for the equity bulls who are desperate for rate cuts.
Precisely. It's that weird dynamic we sometimes see.
And finally, today, the ultimate test of Fed consensus. The highly anticipated speeches from Fed officials later in the day. We've got Dallas Fed President Lori Logan, Atlanta Fed President Raphael Bostic, and Cleveland Fed President Beth Hammack on the schedule.
Yeah, the market is going to intensely scrutinize every single word from them. They'll be looking to see if Chairman Powell's hawkish stance from yesterday represents a unified consensus among the voting members of the FOMC.
What's the risk here?
If these speakers uniformly echo that higher for longer warning, if they emphasize data dependency over any pre-commitment to easing, well then, the upward pressure on long-term Treasury yields will likely be firmly reinforced.
Which would be bad for stocks.
Right. That confirmation would cement the dominant macro headwind and make it very, very difficult for equities to sustain any kind of midday rally we might see.
Okay, let's pivot now to the individual stock level, because today's pre-market activity, it's like a kaleidoscope of extreme catalyst-driven price movements, these massive price gaps we're seeing, both up and down.
They're huge today.
They really are the purest gauge, aren't they, of where high-conviction fundamental money is actually flowing. and what the market is truly rewarding or, well, punishing this morning.
Absolutely. We're seeing institutions making major conviction-based moves based purely on operational performance or lack thereof. The top gainers today, interestingly, are clustered in specialized technology and precision medicine areas where it seems operational excellence can actually overcome these broader macro risks.
Garden Health, GH, is the undisputed leader here this morning. It surged an enormous plus 27.87% to $92.41 pre-market. I mean, a move of that magnitude is never random. What specific operational factors are driving that kind of re-rating?
Yeah, that's a monster move. It was just an overwhelming third quarter result that showed really accelerating operational leverage. Get this, their sales growth accelerated to 34% year over year.
Wow, okay. What was expected?
The consensus estimate was only 22%, so they absolutely blew past the top-line forecast. But I think the most important metric, the one driving this move, was the operational efficiency gain. Their Shield revenues for their cancer screening test hit $24 million versus only a $17 million expectation. And crucially, their gross margins surpassed forecasts by 300 basis points.
300 basis points. So it wasn't just faster growth, it was significantly more profitable growth.
Absolutely critical distinction for a high-growth biotech like Guardant, delivering both accelerated top-line growth and that kind of margin outperformance. It signals a clearer, faster, and much more capital-efficient path to profitability than the market was anticipating.
That sounds like the definition of operational leverage.
It really is. And that operational clarity justified multiple analyst price target raises this morning, including TD Cowen raising their target up to $100. Guardant Health is just a clean example of a company achieving escape velocity, proving that high growth and high efficiency can override even this hawkish Fed environment if the execution is there.
Okay, next up we have two specialized technology players, FormFactor, Form, and Viavi Solutions, VIAV. Both are posting huge gains, over 20% each. Form gained plus 24.16%, and VIAV gained plus 22.32%. This feels like a direct repudiation, doesn't it, of those generalized AI fears we were just discussing with Meta.
It is the perfect counter-narrative to that meta story. Form factor surge is directly tied to its very specific positioning in semiconductor testing, particularly for high bandwidth memory, or HBM.
HVM, that's crucial for AI servers, right?
Exactly. It's a critical component needed for those sophisticated AI servers. And the company confirmed that its HBM-related revenue is tracking over 15% higher year over year. So the market isn't just investing in the idea of AI anymore. It's investing in the specific, tangible, high-margin components required to actually build the AI infrastructure.
The picks and shovels of the AI gold rush.
That's a great analogy. And Viavi Solutions plays a similar specialized role, but more on the networking and data center build-out side.
Right. What drove their big gain?
Viavi had an exceptional earnings beat, but more importantly, they absolutely crushed their forward guidance. They're projecting Q2 revenue between $360 million and $370 million. The consensus was way down at $302 million.
Huge beat on guidance.
Massive. And their optimism, they said, is attributed to robust demand from the data center ecosystem, specifically tied to new network testing and validation requirements as these AI networks get built out. Plus, they cited strength in their aerospace and defense segment.
So taking Form and VIAV together.
Yeah, the combined success of Form and VIAV this morning really shows a clear market preference for these specialized high beta proxies for next-generation infrastructure, CapEx, the picks and shovels, like you said. This is happening even while the mega-cap buyers of that infrastructure, like Meta, are struggling with valuation concerns tied to their spending.
Fascinating divergence within tech itself. Okay, now for the flip side, the top losers. This is where we see evidence of, well, structural damage and serious valuation destruction. FMC Corporation, FMC, is suffering the steepest drop by far, declining a catastrophic negative 46.52% pre-market. Cut in half, basically. This isn't just a bad quarter, is it?
No, this is a textbook example of a stock suffering a structural failure, not just some cyclical dip. Revenue plunged 49% in Q3, which is bad enough. But the truly damaging piece of information, the thing that's causing this massive sell-off, was the 6% price decline they experienced on their existing product portfolio during the quarter.
Okay, explain to the listener why a 6% price decline is actually more damaging than a 49% revenue plunge in this context.
Right, because the revenue plunge could potentially be cyclical, right? Maybe farmers deferred purchasing inputs, maybe commodity prices shifted temporarily. That could theoretically be fixed next quarter or next year. The 6% price decline, however, They specifically attributed that to increased competitive pressure in the market, particularly from generics in Latin America and Asia.
Ah, generics. That sounds bad.
It signals a permanent systemic vulnerability to the company's competitive moat, its protective barrier, and its pricing power. Their proprietary intellectual property, the thing that allowed them to charge premium prices, is now being actively challenged and undercut by cheaper generic competitors.
Which means what for the long term?
It means the entire long-term margin outlook for FMC is likely permanently impaired. The market views this not as a temporary problem, but as a systemic competitive failure, and that necessitates a drastic, permanent re-rating of the stock's valuation. When your pricing power vanishes because of generic pressure, your whole investment thesis is basically broken.
So this is not a buy the dip situation for patient recovery.
I would argue, based on this information, absolutely not. This looks more like a fundamental breakdown of the company's structural advantage in the marketplace.
Wow. Okay, finally on the downside, Apellis Pharmaceuticals, APLS, also saw a very sharp decline, down negative 31.02%.
Yeah, that drop really highlights the inherently binary risk you see in commercial stage biopharma companies. These companies are often treating almost entirely on the promise and the successful commercial ramp-up of just one or two key therapies.
So execution is everything.
Everything. Despite what might have been high prior analyst price targets, this negative reaction implies significant disappointment. It could be in the actual sales volume they reported, or perhaps concerns regarding their operational burn rate, how quickly they're spending cash. A stumble in execution in commercial stage biotech gets punished swiftly and severely, mainly because the financial runway is often very short and market expectations are usually built on near perfection.
Okay, so as we navigate the rest of today and close out the week, the market's strategic focus, it seems, immediately shifts beyond today's catalysts. It moves straight to the highest impact risk event on the immediate calendar. The comprehensive labor market data scheduled for next week, culminating, of course, in the non-farm payrolls, the NFP release, on Friday, November 7th.
Yeah, that NFP report next Friday is arguably the single most important piece of data coming up. It will either validate or potentially destroy the Fed's justification for maintaining its current higher for longer stance.
Because if the Fed is truly data dependent, as they keep saying,
Then the strength or weakness of the labor market is their ultimate guiding star. It's the key piece of data they point to.
and analysts are already signaling a potentially meaningful cooling in the labor market forecast for that report. What are the consensus numbers looking like?
Well, the early consensus forecast for the October NFP number is for an increase of only 55,000 jobs. 55K.
That sounds low.
It is substantially below the historical pace required just to keep up with population growth. It's a clear sign of deceleration if it comes in near there. Furthermore, the unemployment rate is projected to tick up slightly to 4.4%. And crucially, average hourly earnings wage growth, those increases, are expected to cool down to 0.3% month over month and just 3.6% year over year.
Okay, so if those numbers prove correct or even weaker, they signal slowing job creation and decelerating wage inflation, the two primary targets the Fed's been aiming for with its rate hikes.
Exactly.
So this sets up a pretty clear, almost binary scenario based on whether the final number hits, misses, or maybe beats those expectations next Friday.
Absolutely. We have to prepare for two highly divergent potential outcomes. Let's call scenario one, the bullish scenario, NFP miss.
Okay, what happens there?
If the actual report shows a material miss, let's say the NFP number comes in below 50K, or maybe even more importantly, if average hourly earnings...
Okay, that's the bullish case. Now, scenario two, the bearish scenario, NFP beat. What happens if the labor market actually proves much stronger than anticipated next Friday?
Right. A strong beat, let's say we get well over 100,000 jobs added, or maybe average hourly earnings come in hotter than that 3.6% forecast. That would essentially confirm the robust strength of the labor market is still intact.
And that would reinforce Powell's message.
Precisely. It would reinforce Chairman Powell's recent message, validate the higher for longer policy, and demonstrate that maybe the Fed's current restrictive stance isn't even restrictive enough yet. That kind of outcome would likely initiate a broad market sell-off as rate uncertainty and the fear of potentially even more rate hikes get violently reintroduced into the market.
Wow. Okay, so a really high-stakes report next week. Given this binary setup, what are the actionable trading and investment insights coming out of this briefing for you, the listener, over the next few days heading into that report?
Okay, a few things. First, I'd maintain a close track on those fundamental momentum names we highlighted earlier. Guardant Health, Form Factor, and Viavi Solutions. The operational clarity behind their big gains today suggests these could be sustainable re-ratings based on real execution. That makes them potential rotation targets for capital that's seeking quality growth even amidst the uncertainty.
Go watch the winners. What else?
Second, approach those structural damage names like FMC very conservatively. Their pricing power vulnerability, that generic competition issue, often means a permanent reduction in valuation is warranted. It's crucial not to confuse structural failure with just a temporary dip you should buy.
Got it. Be careful with the big losers.
Eh.
And finally, preparation for the volatility spike itself surrounding November 7th.
Yeah, given the intense binary outcome we're anticipating based on this labor data, tactical options strategies seem strongly justified for those comfortable with them. If you are an investor who actively manages volatility, you might consider implementing long straddles or maybe long strangles in the days leading up to November 7th.
Explain that briefly.
Well, that kind of strategy allows you to potentially capitalize on the massive volatility spike we anticipate, regardless of which direction the NFP number ultimately sends the market up or down. The high-impact nature of this data virtually guarantees a violent move one way or the other, and these volatility strategies are specifically designed to capture that kind of dislocation.
Okay, that brings us pretty much full circle. We've spent this deep dive unpacking the market's struggle, really, its attempt to reconcile a hawkish Fed, which is pushing down valuations across the board with pockets of strong, selective fundamental performance in critical areas like specialized AI infrastructure and precision medicine.
Yeah, the key tension really remains unresolved as we head into the trading day. Will that cyclical strength, maybe from energy and Berkshire earnings today, manage to offset the technology drag and the Fed's confirmed resolve? Or will the speaking Fed presidents this afternoon just ensure the bear market narrative gets fed?
And we've seen clearly how the market is specifically punishing that general AI enthusiasm, the meta capex concerns, really illustrate that fear of expensive long-duration bets right now.
Right, but at the same time, it's heavily rewarding that specialized AI infrastructure, the component makers like FormFactor and Viati, they're getting paid today.
So this raises a crucial question, I think, for your own research, for you, the listener, as you move into next week and plan your strategy.
Yeah, the question is, how do you define the difference between necessary future investment and what might be seen as reckless capital expenditure in these high-growth industries? And maybe more importantly, which side of that line does the market expect your portfolio companies to fall on next week, especially when rates are likely to remain elevated?
A truly fantastic and very relevant thought to mull over as we head into the market open. Thank you for joining us for this deep dive into your sources.
My pleasure. Stay nimble out there.
We'll be tracking these colliding forces as they shape the rest of your trading day.